happens. If the stock stayed the same or went in our direction, we profit. The only way we would lose is if it goes against us in direction. Again, the delta would be a negative figure, and our theta would be positive. For the majority of the trades that we're making, we want positive theta. We want theta to be positive at all times. And if theta is not positive, then it gives us a sign that we should probably exit our trades or put on other trades that would give us a positive theta. Why positive theta? Well, remember, there's only two truths to the market. Number one, prices will fluctuate. And number two, all options expire. On the whole, if theta is positive, and we go towards expiration, we will collect more and more of the time value of that option to our account. That's why we always like to sell options that have extrinsic value. The option with the highest extrinsic value is always the at-the-money option. And you can see that it's true here. The time value in the highest theta would be achieved by selling this option at $75 strike price. And you can see it's not only true for the calls, but it's also true for puts. This has a $3.55 extrinsic value on the put side, and if we were to sell both of the calls and the puts at the money, we would achieve a fairly significant amount of theta. Let's just take a look at that. Let's sell that, and let's sell this one. We would achieve close to let's see, $3.80 and $3.40 is $7.20. That's a significant amount of time value that we could collect if we were to sell both of those options. In fact, that is the maximum amount of time value and the highest theta that we could possibly achieve in this particular stock. Let's delete those for a second for this month. If you put on a strategy like that, you could easily do it by going to sell, straddle. And you can see that it once again gives us the mid price of $7.50. And if we took a look at a graph of this, let's analyze this as a duplicate trade and bring up our Analyze tab. You can see that if the price stayed relatively stable, we would have the maximum profit of close to, oops, I got to get rid of that other one. Hold on. There we go. We would have a maximum profit right here of close to $750, which is the amount of credit that we received. It also has a fairly wide break-even. In other words, the stock could move from approximately $67 on the downside before we hit our break-even point, or it could go to $82 on the upside as our break-even point. So it looks like the sale of a credit spread is a very good trade if the stock is going to be the sale of a this is the sale of a straddle, which is the most time premium that we can get in the month of June, would achieve a very nice profit if the price went up a little bit, went down a little bit, or stayed the same. We could achieve a very nice profit on this position. The problem, of course, is that any time you are selling options, you are considered naked those options. When you are naked those options, you have a position in which you could have an unlimited loss. And that is not a good position to be in. Just to prove that that is true, let's shorten up this price a little bit. and I will show you exactly what happens. Here we are at the price. If the price were to move up to 90 and keep going, you could see that in fact the losses would be incredible. Of course, in real life, you may not have those kind of risks because a stock theoretically could go to infinity in price, but in reality it probably would not. You could see that as long as we continue, we would lose more and more money in a linear fashion. So if the stock went from $75 up to $500, we would lose $42,000. And that's not a pleasant situation to be in. Now you might think, well, that's probably impossible. The stock at $75 would never go to $500. However, I can think of a couple of situations in which a stock at $75 could potentially go to $100, $150 or more, resulting in a tremendous loss on these positions. And that is if the company is being bought out, is merging with another company, or an offer to buy the shares of the stock are made on that company. There are a number of factors that could affect the price of those options, and if you're naked those options, theoretically you have an unlimited loss potential for those options. That's why we never sell naked options, and we always do spreads. Now, instead of, if we wanted to capture the maximum amount of time value on these options, rather than just selling those options, let's do the sale of a vertical. We're still selling the 75 call to capture the maximum amount of extrinsic value. But now we're also purchasing a call at the 80 strike price to protect our position from having a huge loss that could potentially be unlimited. Let's also do it on the put side. We're also going to sell a vertical. You notice that we have the same straddle that we had before at the 75 call and the 75 put. The difference is we're also purchasing now a call to protect our position and a put to protect our puts, the sale of our 75 put. Let's analyze these positions. Remember this graph. Let's go back. Now we're going to put both positions on, creating a spread, the sale of a straddle with protected wings. It looks pretty much the same as the other graph, doesn't it? The profit potential is slightly less. Instead of making a maximum of $750, we're only making a maximum of approximately $400. So our profit's a little bit less. However, when you take a look at the potential loss, and if we do get into a situation in which this company is rumored as a takeover target, and the price suddenly jumps from 75 to over $250, well, our maximum loss, it doesn't matter how high the stock goes, our maximum loss is only $109. It doesn't matter. This stock could go to $1,000 and we're still only going to lose $100. That's why spreads are preferred by professional traders over selling of naked options to collect theta. I wanted to show you just one more thing here. That is true for both the upside and the downside on this position. The most we can lose on the downside is $110. And it doesn't matter how low the stock goes. What happens if the stock all of a sudden collapses completely? You would still lose only a maximum of $110. That's why we prefer spreads to the purchase or sale of individual options. Now, even so, even though we have limited upside potential, we have extremely limited downside potential because our maximum loss on this position is only $110.